Don't buy Palantir stock until you watch this analysis video. You'll either want to buy more or avoid it altogether. Let's find out. In this analysis, we're going to look at the business, the intrinsic values, and its technicals. There's a timestamp in the description if you want to skip around. First, does the stock have a good business behind it? We're going to look at 14 metrics to determine how good of a business we have. Each metric will be added up to 70 to see where we are on the scale, which can range from a terrible business all the way to a great business. These first 5 metrics deal with the company's financial health. To get those 5 points, earnings growth will need to be 20% or higher, profit margins will need to be 40% or higher, operational effectiveness will need to be 80% or higher, the average employee value needs to be $400,000 or higher, and the quick ratio will need to be 2.5 or higher for a max 25 points. The next 4 metrics show us the shareholder opportunity. To get those 5 points, a dividend yield will need to be 4% or higher, payout ratio will need to be at 0%, cash and its equivalent will need to be $75 billion or higher, and the stock returns will need to be 15% or higher for a max of 20 points. And the last 5 metrics deal with the company's business valuation. To get those 5 points, the PE ratio will need to be 9.99 or lower, the PEG ratio will need to be at 0.49 or lower, the SMA 200 will need to be at negative 10% or lower, the short float will need to be 0.99% or lower, and the Wall Street rating will need to be 1.49 or lower for a max 25 points. Adding all 14 metrics together, we get the business grade for the company with a max point total of 70 being the perfect business. But as long as the total is above 35, we have a good business behind the stock. For long-term investors, I try to avoid stocks with a weak or terrible business, regardless whether it's undervalued or not. So next, we're going to look at Palantir's intrinsic values to see if the stock is undervalued based on your investment time horizon. First, we'll need to get some requirements out of the way. The stock will need to have a positive earnings per share or else the numbers get quite fuzzy. And if the 5-year projected growth rate isn't available, we're going to just put 0%. It'll all make sense when we go through it. We're going to look at 4 intrinsic value prices based on a 5-year, 10-year, 20-year, and 30-year time frame. You can see in gold where your focus should be based on your investment time horizon. And also, the further we project out, the higher our accuracy is based on my intrinsic value model. For all my intrinsic value models, we're going to need the stock's earnings per share, its growth, which matches the long-term return of the S&P 500 as our baseline returns, and then we have our Wall Street's projected earnings growth for the first 5 years, which is used as our base growth for all our models. For the stock's 5-year model, I'm assuming earnings continue to match inflation for the rest of its existence, and doing the calculation yields the current intrinsic value, which remember is a valuation for short-term investors, so if you're planning to hold the stock for just a couple years, you'll look at this intrinsic value. For the stock's 10-year model, I'm assuming earnings will match inflation for years 6 to 10, and then my assumption is that earnings will stop growing entirely for the rest of its existence. That yields the current intrinsic value, which should be the focus for investors holding for around 10 years. For the stock's 20-year model, I'm assuming earnings will match inflation for years 6 to 10 and then cease to grow at all years 11 to 20, and then after that, I'm making a conservative estimate that earnings will actually decline 3% per year for the rest of its existence. That yields the current intrinsic value, which should be the focus for midlife professionals who have about 20 years left in their investing timeline. And for the stock's 30-year model, same assumptions for the first 30 years, but then after that, I assume earnings will accelerate its decline to 5% per year after that until the end of time, or when the company ceases to exist, whichever comes first. This yields the current intrinsic value for very long-term investors who have a majority of their life to invest. Now, to account for any errors, I included an optional 10% margin of safety, which I personally use. This will lower the intrinsic value by 10% and make the stock 10% more overvalued, but it does mean there's room to maneuver. Here's the adjusted intrinsic values after I include the margin of safety. Note that when I value a company, I use the 10% margin of safety using the 30-year model. Not everyone is going to hold the stock forever, but for however long you're going to own it, you'll know its intrinsic value. Let's go back to the S&P 500's long-term growth. You can adjust this number to whatever you like. Basically, if you want a 10% return per year, that's the intrinsic value. But if you're aiming for a 20% return, for example, you can put 20% and it'll adjust the intrinsic value. You can see here that it makes the stock more overvalued. If you're looking for higher returns, you'll need to pay a lot less, so keep that in mind, but I like to keep it at 10%. Now we can put the points towards the intrinsic value. Remember, for this analysis, I used a 30-year intrinsic value. The points are on a scale from 0 to 100, with 50 being fairly valued, and any total above 50 is considered undervalued. So before we get our final grade, join my Patreon. You'll get access to every company I've analyzed, good for short-term and long-term investors. It's updated all the time. Go to patreon.com/GrowthShares or click on the link in the description. We can now add up our business grade and our intrinsic value. Taking the weights into account, we can surmise the final grade on a 0 to 100 point scale. This can range from a bad investment all the way to a great long-term investment. If you're planning to buy and hold this stock for a long time, I'd only consider the company if the final grade is above 50. Okay, let's pivot and do a technical analysis on Palantir stock to see if, in the short term, it's the right time to buy the stock. In this technical analysis, we're going to look at 4 key technical metrics: the relative strength index, the SMA 20, SMA 50, and SMA 200. We'll award points to each and total them up on a 25-point scale, ranging from a strong sell to a strong buy. The relative strength index tells us whether the stock is overbought or oversold, which is a quick and easy way to see where momentum is heading. The RSI ranges from 0 to 100. The lower that number, the more likely we'll see that momentum swing back to more traders piling into the stock. For this metric, we award a maximum of 10 points. The SMA 20, 50, and 200 show us the 20-day, 50-day, and 200-day stock price averages. While many look at the stock to be above each average, I'm looking for discounts. The more negative that number, the more undervalued I see its stock right now. Each average is graded differently, with the SMA 20 measuring the short-term trend, the SMA 50 measuring the near-term trend, and the SMA 200 measuring the mid-term trend. For each of these metrics, we award a maximum of 5 points. Adding the points of the RSI and the 3 simple moving averages together, we can compare the final grade with the scale and see where the stock lies in its buy and sell cycle. If the points are within the 11 to 15 range, the stock is in a hold pattern. If we have a total above that, we can see the stock has sufficiently been beaten down, and we're aiming for other investors to start buying up the stock. You now have a pretty good idea whether you should invest in Palantir or look elsewhere, regardless if you're investing for 30 days or 30 years. If you found this video helpful, leave a like and subscribe. Invest wisely, and as always, take care of your money.